Hello, everyone. Thank you for joining us for today's EEA Education Series webinar. Today, we will discuss the journey to charter a digital bank in the U.S. with Caitlin Long. Everyone is in listen-only mode. However, you are encouraged to ask questions by using the questions box on your control panel. Today's call is being recorded and will be available to all attendees soon after today's presentation. The Enterprise Ethereum Alliance is a member-driven standards organization whose charter is to develop open blockchain specifications that drive harmonization and interoperability for businesses and consumers worldwide. We welcome any and everyone to join and become a part of our global community. At this time, we are pleased to introduce our moderator, John Whelan.
Hi there, everybody, and welcome to the monthly education series from the Enterprise Ethereum Alliance. Just a quick check on video. Should I be seeing myself on video, or is that being projected? Because I don't see that right now.
You will see yourself.
I see you, John.
Okay,
Yeah.
perfect. Okay, just checking. All right. This month's education webinar is kind of an amazing story. And I'm delighted to be joined by Caitlin Long to discuss the journey to charter a digital bank in the United States. Caitlin is the Chief Executive and founder of Avanti Financial, which is a Wyoming-based crypto bank. Caitlin, you have achieved some measure of fame in the crypto world as being the founder and CEO of Avanti, based in Wyoming. And we will spend quite a lot of time on this later, but first maybe tell us a bit about your career path with a bit of a legal background through the financial industry and the different roles that you have held along the way.
Sure. Thanks so much for having me. It's an honor to be here again. It's been a little bit since I've connected with EEA, but really appreciate the opportunity to reconnect with all of you. I went to law school and figured out I was better at numbers than words, so never practiced. So do have a legal background, but never practiced, just a dormant member of the New York Bar. And instead went to Wall Street and thought I'd pay off my student loans by staying there for a couple of years and ended up staying 22. Started 3 new businesses, both at Credit Suisse and Morgan Stanley. Spent most of my career there with a couple of years at Salomon Brothers, Old Solly before that. So definitely came from a very traditional financial services background. The link to crypto started when I came across Bitcoin in around 2012 and really started digging in early 2013, like so many others. At first I discounted it, and then had an opportunity to really dig in early 2013 and started buying Bitcoin. Figured I'd ask for forgiveness rather than permission from Morgan Stanley, where I was at the time. I read the compliance policy and convinced myself that Bitcoin was the same as a bank account deposit. And it turned out that was the right call, because eventually a Bitcoin forum got going at Morgan Stanley, and I started to pop my head up. I knew, as a managing director running a business, that might be a little dangerous, but finally got the guts to do it. Was lurking for a while and then started posting. And then the chief technology officer called me. I think he saw that I was, relatively gray haired and so to speak, and wanted to know what was going on with this Bitcoin thing. And this was 2015. Maybe late 2014, yeah. And so I worked with him for a couple of years until I left Morgan Stanley to go all in on blockchain in early 2016. That was in addition to my day job. We set up a group, as some of you may recall. There were so many startups forming in 2014 in this sector. And every day there were multiple startups contacting Morgan Stanley, and there was no group that was responsible for vetting them. And I actually really got the bug and started working in addition to my day job on ideas for our corporate clients on how to deploy this technology to solve the real problems that they had in corporate treasury and the real problems I was encountering in my pension solutions business at Morgan Stanley, where I was deep in the weeds on how to transfer assets in markets. For example, one of the things we did was massive asset transfers between ERISA plans, pension plans, and life insurance companies And it turns out that because of the way both of the regulations work, we had to figure out how to transfer all those assets same day. And that was securities and cash and private equity. And within securities, you had privates and publics, you had highly liquid things like equities and things that only traded OTC like corporate bonds and the like. And everything had to transfer same day. Otherwise, the transaction would have been illegal. And so figuring out how to get every single asset that settled on very different settlement cycles and very different back office processes to be able to transfer same day was the orchestration of those transactions. And it was brutal. And boy, did I see there were lots of issues in the financial system in settlement. And roundabout then came Bitcoin, and that sort of, we were doing the first of those big transactions was a $29 billion transaction that General Motors did with Prudential back in 2012. And so just to frame the timing, that's when I started coming across Bitcoin, and you start digging into that and realizing, oh, this is actually going to cut through a lot of the cruft in settlement and enable you to track your assets and settle in minutes. And oh boy, that was going to solve a lot of the very real problems I was encountering at that time in my day job.
So a question about that. I think maybe it sounds like maybe similar to other financial institutions at the time, you recognize that the potential to be able to clear and settle and transact instantly on these new networks, that later became enterprise blockchain to a certain extent. But still, you've been very attracted to Bitcoin, the original DeFi monster in the space, which was designed to be a peer-to-peer electronic cash and subsequently has grown into something that's probably being perceived now a little bit more like digital gold.
Yeah.
Did you always sense when you were working with the early crypto startups in the space and trying to explain the concepts of blockchain and shared ledger technology and the use for settlement of traditional assets, did you always sense perhaps a little bit of tension between what was the original Bitcoin world and this new world of enterprise blockchain?
Oh, 100%. And I took a detour through enterprise blockchain because I thought we would end up, to use Andreas Antonopoulos's analogy, with the intranet before the internet, the walled gardens, that the companies would be very protective of owning their own data. And again, you've got a lot of regulation that requires things like that as well. And so we would have enterprise blockchain networks before the public networks would take off. And I spent a year and a half at a smart contracts platform, Symbiont, which is in some ways a competitor of enterprise Ethereum, because it's an enterprise smart contract system, designed to be decentralized but permissioned. Definitely different in a lot of aspects, but very similar to in the smart contracts area. And I was I was the business side person who spearheaded the pilot project that Symbiont did with Vanguard at the time, to share market index data. And it was interesting because in my Morgan Stanley experience, that was one of the things that the technology group back in 2014, 2015 had identified as a use of blockchain is for market index data, market pricing data, things that are shared infrastructure where there's really no proprietary value. Everybody needs it. Everybody has a reconciliation problem with it. So why don't we start sharing infrastructure for things like that? So there were definitely use cases that were clearly coming out for enterprise blockchain. But I ended up concluding that for the transfer of value, that the public networks were actually going to be superior. And I remember I was, actually invited early on. I remember meeting Vitalik when Vitalik was just Vitalik, and Joe was with him. And actually, the office space that they had was right across the street from Morgan Stanley's headquarters at 1585 Broadway. At the time, they had office space in a shared, co-working environment. And Vitalik was there, and got a chance to meet him before Ethereum did its initial token offering. And And it was very clear that something special was there. But I also was around the engineers. I'm not an engineer, to be clear. I was around the engineers at the time in all the smart contracting discussions. It was clear that Bitcoin was going to have challenges putting smart contracts onto Bitcoin, and Ethereum was the attempt at that. And I got to say, hats off to Ethereum. It's done better than a lot of the engineers thought it would do because of how fast it was put out there. And it's a perfect example of just get something out there, get it working, it's good enough, and it gets the network effects going. And yeah, it's got all kinds of issues. I feel like it's a couple years behind. This is the public Ethereum, is a couple years behind Bitcoin. It's facing its scaling issues now. Bitcoin kind of went through that a couple years ago. And of course, Ethereum is newer than Bitcoin. But I've always thought the two of them had different roles and absolutely would coexist. And I'm a believer in public Ethereum. So I recognize that a lot of the listeners here are not going to be able to use that in their businesses because of data storage requirements, controlling your own data, exclusivity of data, those kinds of thorny questions. But I ended up deciding the enterprise detour, if you will, was just that it was actually going to be building private applications on top of the public backend blockchain networks. And that is indeed what has happened over the last few years. And I think it's going to continue. That those public blockchain networks are good enough. Sorry, go ahead.
No, I was going to say, Caitlin, I think you're right. I think this concept of permissioning originally was really more about, do we control the whole network and the validator nodes and everything? When in reality, if you can deploy an application on top of a public blockchain and permission that application so that only permissioned actors can interact with it, you get all the wonderful benefit of distributed consensus and economic security that the public chains have already. So there's definitely logic to the mental journey that you've been on, and I think that there are probably many folks from similar background that have been through the big corporate heavy enterprise blockchain projects, have come to similar conclusions along the way. But having said that, there are still many of the enterprise blockchain projects that have their own cadence and progress, and we'll see where they ultimately end up. Can I ask a little bit about the differences between the types of people that you encountered along the way in traditional finance versus those that perhaps you found maybe inspirational from the open source crypto community? Maybe just the different characters involved in who you've met along the way.
Oh boy, lots of characters for sure. And now it's more common for folks like me to have left, the big traditional financial world and gone into crypto. That's a lot more common now. But boy, it wasn't back then. I remember one of the big characters in crypto, Matt Rozak at the time, said to me, you're one of the first to leave the big banks and go all in on crypto, and you will not be the last. There's going to be a big trend of that, and indeed it has happened. But what I would share is that the characteristics, there are super smart people, super smart developers in both worlds, but the systems are so different. And ultimately, that's one of the reasons why I concluded that we just need to build bridges between the two of them, but they're ultimately going to be building in parallel. You're not going to be seeing a lot of distributed system stuff, shared infrastructure stuff inside the big walled garden centralized institutions that operate in that multi-layered intermediary system. And I'll come back and explain why in a minute, but the crypto system, it's not that it doesn't have intermediaries, it's that we don't have the hierarchy because we don't have that central clearinghouse at the top. Okay, so let me come back then and explain what I meant by the multi-layered. The system that we have, both for dollars and for securities in the traditional world, has the giant clearinghouse at the top. For dollars, it's the Fed, and for in the U.S. and for securities, it's the DTC. It works very similarly in pretty much every developed country. You've got a giant clearinghouse, which is the central bank for money, and you've got a securities clearinghouse, the DTC, Euroclear, Clearstream, et cetera, in the securities world. And then you've got So that at the next layer down, you've got in securities, you've got your custodians. And then in payments, you've got your correspondent banks, the money center banks through which that provide clearing services for the smaller banks. And then underneath each of them, you've got, thousands of broker dealers and thousands of, community banks and smaller banks, each of which specialize in whatever they do. Okay, but what you've ultimately got, I'm way simplifying this, but what you've really got is a 3-layered system. And so every trade has to go from the broker dealer to the custodian, to the clearing house, to the counterparty's custodian, to the counterparty's broker dealer, right? So you're touching 5 legal entities. And it used to be that every legal entity settled overnight. When I started in equities in the early 90s, everybody settled overnight, and it took 5 days to settle a trade. Well, I just explained to you why it took 5 days to settle a trade, because you had 5 different legal entities involved. If you're doing foreign exchange on the dollar side, you got 2 central banks involved, right? So you got a minimum of 6 legal entities, probably more. And this is why it takes so much time to move money. So how do you plug in a distributed system, shared infrastructure, real-time gross settlement structure into that market structure, where you've got all these intermediaries and they all have to settle in sequence? We've certainly sped up the settlement times, no question, in the traditional world, but we're still at T+2 days to settle a stock trade in Europe and the US. And we don't, that long ago was no longer a technology problem. That is a market structure problem. Okay, and so here comes crypto, both for securities with smart contracts. And again, this is where I think the Ethereum projects are so powerful, because that's where you're seeing the security token issuance. We can start to put securities into these blockchain networks. I am a huge fan of that because of the settlement problems, of which, the GameStop drama in the US is just one. How did that thing end up being 138% sold short? That is just yet another in a long string of problems that we have seen, similar problems in Wall Street's bookkeeping systems, because these layers of intermediaries don't have systems that are in sync. There never ever is a moment where the systems are in perfect sync with each other. So you don't really have an accurate ledger. That's what took me a long time to figure out. When you've got this much, going on, you need fault tolerance in the system. And the regulators allow for the fault tolerance in the system. And you see it in so many places. But long ago, we've had the technology to not need that anymore. And so whether it's a blockchain or whether it's just, faster settlement cycles that we do with centralized databases, we don't need a blockchain to speed up settlement cycles. Definitely a blockchain will, but the next point, though, is that we're stuck with this market infrastructure, that the market structure, rather, with these multiple layers, and it's just fundamentally incompatible. That's what I realized. And so when you ask about the characters, the developers have very different skills. A blockchain developer, especially a public blockchain developer, is going to look at that world where everything has to settle up through a clearinghouse and say, why are we doing it this way? Why don't we enable peer-to-peer? And that's just a very, very different way of looking at the world. And that is ultimately why I think the 2 systems are growing up in parallel. What we need to build is bridges between the 2, so money can go back and forth between the 2. And I'm really, really eager to see how the SEC handles this GameStop situation, in part because you would not in a blockchain system have a stock sold 138% short, where there's 38% more claims to the shares than actual shares existed. It just isn't going to happen in a blockchain system. And so if the SEC in the US starts green lighting more experimentation with security tokens, and you have the 2 systems, then the issuers can choose which one they issue securities in. And we will start to see, I think, the market voting with its feet, especially as we get some of the scaling issues in Ethereum improved. We will see a lot of security token issuance. And I'm psyched for that, because one of the things we did at Avanti is make sure that we are authorized to provide custody services for security tokens. Very different type of custody than custody services for traditional securities.
Sounds like almost an intractable set of problems for the traditional financial industry to solve, particularly in the face of a new technology, which is a fundamentally different way of looking at the world. Let's change tack slightly. I'd like to ask you about Wyoming. Are you from Wyoming originally? And
Yes.
you went to school, I know you went to school in Wyoming, but it has become one of the leading destinations for blockchain startups, in particular crypto banks. Can you describe perhaps some of the journey that the state of Wyoming has been on, and in particular, your involvement and support along the way?
Yes, we had a very simple approach, which is that we recognize the value of this technology and we wanted to make it backwards compatible with the legal system. So what we did was do everything we could to enable it. So the developers, especially the code is law folks, of which there are many in the Ethereum world, looked at us and said, we don't need you. Well, but the mainstream institutions who will use this, they do need legal certainty of the transactions. They do need to know that if there's a dispute and it ends up in court, how is a judge going to, what's the roadmap the judge is going to use? They do need to know, especially the SEC and the Fed needed to know if financial institutions are involved with these things. Do we know what the legal clarity is in the event that the financial institution fails and it all has to be unwound in a bankruptcy? Those are really boring, but thorny and critically important questions. And that's what we did. We did some fun stuff too. You know, we have a code of speech bill that that protects developers who put open source code out, that the developers are not going to be liable for their projects. It's the use of the code, if it's used illegally or in a crime, that is the crime. It's not the fact that the developers put code out. So those kinds of things we did. And this year, actually, we're not done. We've done 20 laws, 20 bills passed the legislature in 3 different legislative sessions so far since we started. And we're in the 4th one now, just getting going. And for the Ethereum community, there's a really interesting one that the consensus folks have been working on, which is the DAO bill. We are actually recognizing decentralized autonomous organizations, whether they have to be formed by a human, but a human doesn't actually have to be involved in the management of them. And the whole point of this is to give some legal certainty to the transaction so they don't exist in a world of their own, and to allow, again, a judge to recognize that, yes, those are legally enforceable transactions and the parties will know what the rights and obligations in a commercial transaction are. And so there have been some critics of that one, but I'm pretty sure that one's going to pass. And so Wyoming will be the first. And just to give you a sense, Wyoming also historically, we're a state that's not afraid to be first. We're a state that has jumped out ahead of the curve, even when it's controversial. We were the first state to give women the right to vote 50 years before it became official and was added in the Constitution in the United States. And most importantly, most relevant, we invented the limited liability company in 1977. That is the most popular form of legal entity registration in the United States. Delaware leapfrogged us, but we are number 2 and have been number 2 for a long time in new business entity registrations in Wyoming. So there is a history of innovation here. And I think, what we're doing with the DAOs is taking it to that next level, that you can have a limited liability organization that has legal substance and isn't operated by a human and doesn't have a board of directors, et cetera, et cetera.
Incredible foresight, in addition to being one of the most beautiful parts of the world with the Grand Tetons and Jackson Hole in Yellowstone, which not many people outside the US know that, I guess. At what point did you start to realize there was a real opportunity in Wyoming to enact legislation that would allow the formation of crypto-friendly financial institutions? Was there a particular...
Oh, sorry. Yes, it's funny because there was, we started from the back of the pack, Wyoming did. We had a bad money transmitter law. There were 3 of the 50 United States that had a money transmitter law that was written the way Wyoming's was, and it just wasn't future-proof. And I tried to donate appreciated Bitcoin in 2017 to endow a scholarship at the University of Wyoming for female engineers, and discovered that as a Wyoming corporation, the University of Wyoming Foundation would not be able to do business with any of the Coinbases or Circles of the world who could liquidate the Bitcoin to dollars. And at the time, they didn't have authority to hold on to the Bitcoin. And so having been a Wyoming resident, having served on the University of Wyoming Foundation Board for 2 terms before that, and always had one foot back home here, always planned to come back at some point from New York after 30 years on the East Coast. I said, all right, we're gonna, this whole crypto thing is gonna be a big deal. We have to fix this, otherwise Wyoming's just gonna miss it. So we came from the back of the pack to the front by me just talking to some of the folks and saying, we got to get this fixed. I will volunteer. I used to be an intern at the Wyoming legislature in college, so I will volunteer to come out and spend some time out here and educate the legislators. And that's what it took. It took a lot of handholding and it took a lot of people. I'm just the face of this. Sometimes I'm uncomfortable with how much credit I'm getting because, of course, there were a ton of people. Something like this does not happen with one person. Maybe one person's the catalyst, but to get it going. But there was a core group of 3 of us, and then of course a broader core group who also made it happen. But the most important people came together were a very powerful legislator who happened to be a Ron Paul supporter. So somebody had donated his campaign Bitcoin, so he was familiar with it. And then also a legislative attorney who was deeply curious and super great at figuring out how all the puzzle pieces fit together in really complicated areas of the law, like the Uniform Commercial Code. And so the 3 of us, I mean, there were times in Christmas of 2018, I worked 4 hours on Christmas Day. This was an intense project, but such a meaningful project. And for a non-developer in crypto, it was one of the ways that I could contribute to the advancement of the industry.
That brings us to Avanti Bank Trust itself, just over a year old,
Yep.
An amazing achievement in getting launched, that's clear. Tell us the story behind the launch of Avanti. I'm sure that there is a yet to be written inside tell-all of trials and tribulations. How did you get here? Who was involved? And how often did you think about giving up along the way?
Well, first of all, we're not launched yet, to be clear. We're chartered. That is the gating item. You've got to get your bank charter, but it's almost like constructing a home. The building inspectors have to come several times, and until you get your certificate of occupancy, you can't move in. So we don't have our certificate of authority to operate, which is the equivalent of the certificate of occupancy. There's a lot that has to be done. It is a lot harder to start a bank, a clearing bank. We are a clearing bank, and I'll come back and talk about that in a minute. It is a lot harder than it should be. It will ultimately have taken us about 18 months. Realistically, we're looking at launching, in around the summertime this year. So yes, there've been delays along the way. It's been a windy road. We're dealing directly with the Fed because we're a bank, and we're specifically the type of charter that we created in Wyoming is designed for digital assets. And there were a couple of structuring things that we knew we needed to do. It's the first new type of bank charter in the U.S. in 40 years. And we're on the verge of getting approval from the Federal Reserve. We don't have it yet. And Kraken, the exchange, is actually about 6 weeks ahead of us in terms of getting their charter. We both are fully chartered banks, no conditions to our charters, but we're not authorized to operate yet. To be able to operate as a full clearing bank, there are so many rules about the technology. The Federal Reserve, as are all central banks, I'm sure, around the world, are very protective of those who can access the payment system. And you have to do it in a very particular way. And you can't just come in, as somebody from Silicon Valley in a hoodie and first of all expect to be treated seriously by the Fed. That you have to have a serious group of people with a lot of experience in terms of your management team and your board. In fact, actually, I talked to a lot of people in the Ethereum community who wanted to start a bank that could custody security tokens. And because banks have special privileges in the United States regarding custody of securities, under something called Gramm-Leach-Bliley, there are 11 different categories of securities exemptions, exemptions from registration under as a broker-dealer that banks have that non-banks do not. And so there were a lot of Ethereum people around who were working on this as well. We had about 150 inquiries, and I was trying to get them all through the door. But boy, I realized how hard it was when it was even difficult to get Kraken to the starting gate, much less the finish line. And ultimately, when I saw there weren't others that were going to be able to step up and do this, I thought, well, I've got the background to bring a credible case to the Fed. And so I'm going to go ahead and roll up sleeves and come out of retirement and do this. And boy, it's been intense. So the book's not written yet, and we're not launched yet, but we are we're on the we're getting to the finish line, and we are actually going to have direct connectivity to Ethereum. We can talk about that a little bit later.
Along the way, just have you received, let's say, different feedback or support, or the opposite of support, from the crypto industry versus the mainstream financial industry, or have both been broadly very enthusiastic and offering high degrees of encouragement and assistance?
Oh boy, no, I mean, the maximalists, of course, even everything I've done in Wyoming, there are some maximalists who think code is law and we don't need any of this, right? So, so sure, it's more on the margins, and we see that among mainstream financial institutions as well. That you know, the traditional banks definitely have a strong lobbying arm in Washington D.C., and even in the state of Wyoming, you know, we had opposition from the traditional banks the entire way. It was funny. I was just thinking about it over the weekend. I was called a terrorist who was doing business with Iran openly by one of the big banks in Wyoming. And of course, I've never done that. And of course, this was somebody who didn't understand how blockchains worked and was just parroting, you know, the fear, uncertainty, and doubt that we all in this industry have been dealing with all along. As in an effort to go mainstream. Fewer people, I think, would think that now than back in 2017. But yeah, absolutely, it's not been an easy, straight path. But what we've done is just keep our heads down and power forward.
Let's talk products. Obviously, Avanti is a bank. Banks offer a variety of financial products to their clients and customers. Who do you see as being your ideal customer in the post-launch phase, and what are the first set of products and services that you think you'll be in a position to offer?
Well, we'll talk about two groups on the product side that we have publicly disclosed. There's more, of course, in the works that we haven't publicly disclosed, but the most important ones are, we're going to be a tech-forward bank that has APIs, and our APIs will allow customers to originate transactions. A lot of banks are well, not a lot, a handful of banks, especially the big ones, have APIs now, but mostly it's for reconciliation and checking balances. You're not originating transactions. That's generally still done through some form of a batch file or a form fill. Whereas we will actually offer APIs that will allow customers to originate wires, ACH, SWIFT, etc. So that's the first group of products, is just payments, you know, being that clearing bank. The second one is the eea-eth product. That's the one that our customers are by far the most excited about, and we will be issuing. We have announced we'll be issuing that on two different blockchains. One is Ethereum, and the other is the Liquid sidechain of Bitcoin. I should say, from a customer perspective. Oh, I didn't answer your question about customers. Sorry about that. There's a little bit of a delay here. From a customer perspective, we are institutional focused. So our customers are institutions. We are authorized to do business with individuals that have high minimum balances, but a lot of your listeners are going to be in the traditional financial world, and you realize the compliance requirements go up massively once you start doing business with individuals relative to institutions. So we're truly an institutional play, and that's where the team mostly comes from. We're mostly institutional folks.
So you'll see that your first cohort of customers are likely to be, let's say, potentially other banks, non-bank financial institutions, hedge funds, family offices, high net worth individuals, perhaps even traditional asset managers that are looking to put, let's say, crypto assets, Bitcoin and Ether, and potentially others on their balance sheets, etc., give their clients exposure. A question then, outside of Wyoming, to what extent do you think that existing legislation in the United States is supportive of the crypto industry? And do you see some obvious changes that are needed in order for it to grow?
Oh boy, yes. The laws are not set up in the United States to recognize crypto. It falls in between the buckets of what we've in the traditional world been so used to dealing with. You know where the dividing line between a bank's products, a broker dealer's products, and the CFTC commodity stack products are, and then derivatives. You know, yes, there's some gray areas around the edges. Is something a security or is it not? But it's pretty well established. And then here comes crypto, and it can fit into all of those buckets actually. And so yes, we've got a lot of work to do. And Wyoming did jump out ahead in clarifying the commercial law treatment of Bitcoin. That's the most important thing. It's the biggest building block. You've got to know that your transaction is legally enforceable. And if you go out and start looking at some of the big players in the crypto sector, not talking about traditional financial services, I'm talking about the open source projects. The biggest regulated stablecoin, for example, if you scroll the terms and conditions on the website, it says we're not sure that transactions involving this are legally enforceable anywhere in the world, right? And so if you look at, if you're a bank, you know, looking at getting involved with that product, your legal and compliance people are like, whoa, if I don't know this is legally enforceable, I can't touch this. So we absolutely had to solve those things. And that's exactly what Avanti's working on. So our payment token product that will be issued on those two blockchain networks, including Ethereum, it's a different legal structure than a stablecoin. It's not actually a stablecoin, it's a banknote. And because we're a bank and because we can put it into a different bucket, there's a lot that we can do to make it usable by mainstream institutions. And I will say one of the interesting things about it is the caliber of the mainstream institutions that have been contacting us, because they see what we're doing, they understand how it fits into solving their problems. You know, I worked with corporate treasurers, like I said earlier in my career, still very much in touch with them. We have a Fortune 10 corporate treasurer as an advisor to our company, and he brought in, we haven't publicly announced, so I'll keep his name confidential for now, but he brought in his former head of Treasury IT. And the reason they got so excited about us is they think we solved that last mile problem. Namely, ERP systems have been around for 25 years now. You know, in a supply chain type business, they'll spit out an invoice. The invoice, that ERP system is integrated with the treasury management system. And then the treasury management system will create the batch file to send the payments to the bank. Okay, well, where's the break in that straight through process? It's the creation of the batch file to send the payments to the bank. And then, the batch file comes back the next morning and you got a reconciliation problem, and then your ops people have to go deal with the fails. And especially if there's money going overseas, sometimes it just goes into a black hole with Swift, right? So it's a problem. It's part of the reason why corporate treasury staffs are big. And the same is true in the settlement systems of the securities and derivatives and commodities industries as well. So that payment problem is a big one. We ultimately want to get straight through processing from invoice to payment and reconciliation, all API based, and not have the fails. And this we've heard from a couple of companies. They were so excited about the blockchain software vendors that were working on this project, the Ripples, the IBM Stellar projects of the world that are being used actively, because they do add value to that chain. By what's happening is a lot of the players are actually, if there's a lot of transactions going back and forth between two counterparties, they'll use that software to do the advanced reconciliation before the batch file gets created, because then you have, you know which payments are going to fail and you fix them before you send the payment. And so it reduces your operational workflow, because you're not having to fix a lost payment, you're fixing it before the payment instruction goes. But that caliber of folks that are working on that problem, and this is why, again, the folks that joined us as advisors from this Fortune 10 company previously, they're both retired. They saw the ability to plug in the bank and not to have to send batch files to the bank as that last mile problem. Yeah. And so having a tech stack that enables you to go from front to back and back again without manual intervention is where we're trying to get to. I should say one of the most important things about Avanti, even though we're a de novo bank, and of course we're going to be small relative to the behemoths, we are 100% reserve. That's the type of bank charter that we have. So we're not taking credit and interest rate risk. I think that is the only way that digital assets, which settle in minutes with irreversibility, I think that's the only responsible way for the banking system to integrate in with digital assets. Because if you put leveraged financial institutions together with clearing for digital assets, especially a digital dollar like what I'm talking about, you could have very, very easily and very foreseeably a bank, if a leveraged bank is doing this, and they're playing the yield curve, so they've got long-term assets, typical fractional reserve lending bank, and now all of a sudden they start clearing a US dollar stablecoin like instrument that clears and settles with irreversibility in 3 minutes on Ethereum. And then what if something goes wrong and you get a mass withdrawal of cash at the bank in minutes? And then what if that bank just happens to be overdrawn at the Fed that day? Then you've got a payment system loss. Okay, the Fed, I have deep respect for what the Fed does that I didn't understand that they did before I started working on this process. The most important thing the Fed does is not monetary policy. The most important thing the Fed does is operate the payment system and make sure there's no payment system loss. Okay, so they get this, that again, we're talking about the old world versus the new world. The old world with that kind of fractional reserve lending, things just didn't happen that fast, and so the banks could play the yield curve and take the interest rate risk. But now let's think of a real world example. We had an accidental fork on Ethereum a couple of months ago, and the most of the stable coins are ERC20 tokens. So there were a couple of hours there where our engineers were worried that if we had been operating, we would have had to have redeemed all the tokens on one of the forks and reissued on the other one. So that's an actual mass withdrawal of cash that happens in the span of minutes that nobody was expecting. And that is exactly the kind of risk that when you start to put these two systems together, you have to think about. And so the way to do this, and coming back to, would a large institution, or maybe because we know they're calling us, why are they calling us? They see us as, yes, we're a small bank, but as a bank that's not lending, we don't have the counterparty credit exposure that most banks do. We may actually be less risky from a counterparty perspective. And if we're offering the ability to settle US dollars in minutes with traceability and irreversibility, there are certain types of payments for which corporate treasurers would really value that. And we're just another menu item on the menu. This is not meant to disrupt any of the existing payment systems. It's just a payment system that has different characteristics. And we are approved already for this payment system, but not yet approved at the Fed, and not yet approved, to be clear, to open and operate yet. But we're already approved to issue that eea-eth payment token.
Speaking of corporate treasurers, big news from a couple of days ago. Elon Musk, in between tweeting about Bitcoin and Dogecoin, Tesla, in a filing with the SEC, has announced that they have purchased $1.5 billion worth of Bitcoin for its balance sheet. Obviously, a huge move from a publicly listed, hugely valuable corporation. What's your opinion about the macro implications of such a balance sheet add?
Yeah, I've been a little more skeptical because of all the work I've done with corporate treasurers, of the hype around the corporates are going to buy a lot of Bitcoin. Okay, and one of the reasons is the accounting. And again, your audience is a lot of institutional people. You will get this drill. If you've ever put a new product together for a big investment bank, you're going to have to check, the traders box, the risk person's box, the product controller's box, the regulatory controller's box, the corporate treasurer's box, and then of course legal and tax and compliance, right? You've got to herd all those cats. And the first thing you're going to run into if you take this idea to your boss is they're going to say, what's the accounting for it? And the accounting is ugly under US GAAP. And I'm pretty sure under IFRS, but don't quote me on that. I don't know for sure. I just definitely know US GAAP. Because I started looking at this back in 2014 when Overstock.com started accepting Bitcoin, right? So this is not new. The accounting for direct investments in crypto, Ethereum, whatever crypto asset, with the exception of a banknote, I will say. But the accounting for crypto is something called an indefinite intangible, and what that is essentially in plain English, and I'm not an accountant, so definitely go look to the accounting firms. Deloitte put out a really good paper as part of the MicroStrategy in Bitcoin for Corporates, teach-in that happened about a week ago. So go to that website if you'd like to see it. But long story short, the accounting is ugly because it's the lower of cost or market. You cannot mark your Bitcoin investment up. You can only mark it down through impairment charges. And corporate treasurers and corporate CFOs and frankly CEOs and boards hate the impairment charge concept because a surprise can come out of left field and all of a sudden you had a blowout quarter in your business and now you're taking a charge because your Bitcoin investment went down. Most corporate compensation plans are tied to reported earnings per share. And so if you get a one-time hit like that, you can wipe out all your income, in 1 year. So what I put out a tweet storm on this a couple of days ago. I think this is the reason why Square only put 2% of its corporate cash into Bitcoin. The obvious question is, why not more? If you believe in it that much, why not more? Same thing with Tesla. At 7.7% of its corporate cash, they did disclose that this was not considered operating cash. And so this was sort of excess cash, right? I think the big tech companies with these huge tech piles have definitely been taking a little bit of risk. They're not sitting, that cash is not sitting in corporate or in bank accounts or in T-bills. It's definitely invested with a little bit of risk, the non-operating cash, right? But the problem is that, every business is going to look at how much of an impairment charge are we willing to take in a Bitcoin bear market? And then they're going to size their investment in part, among other factors, with that in mind, because their shareholders are not going to be happy if suddenly they do, they hit the ball out of the ballpark in their operating business and they end up having to take it all back because of an impairment charge on their crypto position. So I don't think this is as big an opportunity for the world of crypto until that accounting is changed. I will note one of the things that we did in Wyoming is that we treat, for commercial law purposes, this is not accounting, I'm switching gears now, but we treat Bitcoin as money under commercial law. And this gets into a whole different line of questioning. But where I'm going is that I do believe the accountants ultimately should treat Bitcoin as another currency, just like other fiat currencies. If you have an investment, if you're a US company and you have an investment in, euros or yen, that's not treated as an indefinite intangible. Bitcoin's just another foreign exchange currency, and it needs to be treated as such for accounting purposes. And I do believe that we'll get there, but I think it's going to take time. You have the bizarre situation where if the company buys Bitcoin through Grayscale's fund, they can mark it up and down. But if they buy Bitcoin directly, they can only mark it down until they sell it. That's just the wrong outcome. And so I'm hoping that the accounting profession fixes this.
Okay. We have about 10 minutes left before your hard stop at 30 minutes past the hour. So I think we're going to open it up to Q&A a little bit. I do see a question here that was asked in the Q&A folder, which is central bank digital currencies. What do you think? And do you think that they will be, should be, or even need to be based on some form of distributed ledger, be it permissioned or permissionless or something in between?
Well, they don't need to be, and central banks, of course, have the monopoly power to issue the legal tender in the country, and so they get to decide what the payment systems look like. Yes, I think we'll end up with a mix, right? I mean, it's like so much of this world. We used to only have, Coke and Pepsi. Now we've got, all kinds of different choices in the cola wars, right? And so I think we're going to end up with just a much broader menu of choices. And I think what will happen also in the central bank world is some will go with blockchain based distributed system backend CBDCs, and others will not. They'll just issue digital dollars, but we will have massive upgrades in the systems. The US is behind the rest of the world. I recognize that. In part because they've moved more slowly because the dollar is the world's reserve currency. And in part, there's a lot inside the banking system that I understand a lot better now. Because of the very controlled nature of plugging into the central banks, and I would imagine this is true in most countries, it has to be done in a very particular way. And there are only some approved vendors that you can use who do it. And of course, when you bestow a regulatory monopoly like that, what happens to the monopoly players? They atrophy. And that's what's happened. That's one of the reasons why the payment system in the US is so far behind the innovation in the rest of the world, because there was a small group of core systems that the banks were allowed to plug in through, and they were the approved vendors, and there just wasn't a lot of competition and not a lot of fire lit under them to innovate, which is a shame. That's changing though. I'm pretty excited about that, because we'll be one of the first banks to use what's called a modern core system. And again, that's why folks are finding us, because they understand what that means in terms of just plain old, ACH wires and SWIFT transfers, leaving all the crypto stuff aside. So yeah, I totally went
another
on a
question
tangent
here.
and lost your question.
No, you answered the question perfectly, actually. Another question here, probably one that you would find from the open source crypto anarchist community that would be flaming you on Twitter. So I'm going to ask anyway, it's a little bit provocative. The crypto movement is about separation of money and state and not merging it. Please comment. I think you answered some of that already.
Yeah, well, no, I agree with it. I actually am a big believer in freedom in money and competition. What I just talked about, the atrophy, right? If we'd had competition instead of the regulatory bestowed monopoly, I think we would have had a lot more innovation in payments in the US in the last 15 years. But so I'm all for the innovation. I call myself a long-term maximalist, because I think there's so much innovation and so much that we can learn in the interim, and that both with Bitcoin and Ethereum, the innovations that are happening around the edges of this sector, if they really are great, they'll be implemented into Bitcoin and Ethereum. So I'm all for the experimentation. And so to answer the question directly, you need bridges between the two. How does money move between the two? And so even if you do believe long-term in the maximalist argument, literally you've got to have pipes to get back and forth between the two. Otherwise, it's just a much, much longer road. And so ultimately that is the value that we're providing. We are building a secure, compliant bridge between the two systems.
A question here, I guess that's related. Do you believe that there is a war? I'm going to say tension, because I think that's probably a better adjective in this case. Do you think that there is a tension between privately issued digital currencies, could be stable coins, could be depository coins or depository instruments like you're working on yourself, and central bank digital currencies, with the first possibly primarily being interested in profit, let's say, or private motives, and the second being more about preservation of stability in the financial system and implementation of monetary policy?
Well, this gets into the question: will all these private blockchain innovations just be swept away by a CBDC? And the first question you have to ask yourself is: are the central banks prepared to provide customer service to, in the US, for example, 350 million individuals and hundreds of millions of businesses? The answer is not now. I mean, they deal with a few hundred banks. That's their direct customers, and that's it. They're not set up to do all the compliance, onboarding, know your customer, anti-money laundering work. That's what the banks do. And they're not set up with customer service and the like. So my view is that most likely the two-tiered banking system will be retained. You'll have the central banks issuing central bank money to the banks, who turn around and issue it to the end users as commercial bank money. But I think that the model that Avanti has, that the Wyoming Speedy Banks have, which is that we're not going to take the interest rate or credit risk that we once did, because the settlement cycles are too short, and the finality of the payments, you don't have this clawback risk with blockchains that you do. That is to some people a feature in certain instances, and to others in other instances it's a bug. But again, you've got a menu now. So if you really don't want clawback, you start, you send it through a blockchain system, right? Those are the kinds of things that I think will happen, and the commercial banks will be the ones who distribute CBDC on behalf of the central bank. That is most likely what's going to happen. We will continue to keep the intermediaries. I also think ultimately we will evolve that the intermediaries are not counterparties. It used to be that when money was gold, you actually had money warehouses. The banks started out as literally money warehouses, and they would give a warehouse receipt, which you would you could exchange in the marketplace. But the banks weren't these big balance sheets, these big leveraged balance sheets, and you weren't forced into a counterparty relationship. Legally, when you deposited your gold at a bank in the United States in the say 1870s, that gold was still yours, and the bank was just possessing it temporarily. It's something called a bailment, which is anyone with a legal background, especially working in the UK, will recognize this. Bailment is a common law concept that we all use every day. We use it when we check our code at a coat check, or when we valet park our car at a parking garage. That garage does not have legal title to your car. They just have temporary possession. It's a directed trustee type of arrangement. And if the garage goes bankrupt while your car is parked there, you can take your car out without having to go ask permission from a bankruptcy judge, because it was never part of the garage's property. Whereas right now, the way we've set up intermediaries, when you deposit money at a bank, or when you put your stock certificates at a broker dealer, that becomes the bank and broker dealer's property. It's not yours anymore. They just owe it to you. So you're forced into a counterparty relationship. I think we will go to a new world, and Wyoming is on the forefront of this. None of the crypto institutions, the big players in crypto, are set up this way. The Wyoming Speedy Banks are, where you can actually do business with us with your crypto, not with your dollars, but with your crypto. You can do business with us on that valet parking type of legal structure, where you retain legal title to it. And if we go bust, you can take it out without having to go through a bankruptcy judge. Anyone who went through the Lehman or MF Global or Refco experiences understands the value of that.
Quick question here. We've got about a minute left.
Yeah.
And it's a product question about Avanti. Beyond institutional customers, will fintech companies be able to work with Avanti as a bank, as a platform, and they can build services on top that serves retail and whatever they imagine their apps serving?
Yes. It is amazing how many fintechs have discovered us because they understand what we are, and they understand our tech team has the chops to build something that is very tech forward. And yes.
Outstanding. Listen, understanding you're under tight time constraints, Caitlin, I want to say, by the way, I have found this discussion to be absolutely inspirational. And I mean that from a personal point of view, working in an old world financial institution. It is just wonderful to hear such a level of expertise and thinking about how to connect the two. I'm hoping, I have no doubt that many of our listeners and viewers today would think the same. So ladies and gentlemen, with 30 seconds left, I'm going to draw this to this educational webinar to a close. I want to say a profound thank you again to Caitlin Long, founder and CEO of Avanti Bank Trust in the beautiful state of Wyoming in the United States of America.
Thank you so much. Thanks to EEA. Good to see you all again.
Thank you, Caitlin, for joining us today. Please feel free to place your social media handles in the chat so all attendees can follow your work. This call was sponsored by the EEA Financial Services Interest Group. If you are more interested in the leading blockchain going on within EEA, please send an email to membership@enethealliance.org. Again, that's membership@enethealliance.org. Thank you. This concludes today's EEA Education Series webinar.